Well, hello, this is Briant Sikorski. Thanks for joining me today. I'm an independent wealth advisor with Stratos Wealth Partners, and as a wealth advisor, I help clients work toward achieving their financial goals. I usually do this by providing them planning services, including financial, insurance, retirement income, and education savings. Asset and income protection, and I'll usually utilize things like life, disability, and long-term care insurance. Investment management, including brokerage and advisory accounts consisting of stocks, bonds, mutual funds, and exchange-traded funds. And finally, tax-deferred retirement income strategies. These may include fixed indexed, or variable annuity products. Also, I look at it as my role to continue to educate and inform my clients, and that's the reason for these series of videos. When I've completed this call, I will take the recording and I will upload it to my YouTube channel. So you can go to BriantSikorski.com, click on the YouTube icon, and you can watch this again at any time in the future. So today, our topic is LPL Research's, or I should say LPL Financial Research Department's Outlook 2018, and it's entitled The Return of the Business Cycle. So we often talk about cycles in terms of economic periods of recession and expansion. And while we're not returning to the beginning of that economic cycle, what we're referring to here is a return to the more traditional drivers that propel the cycle. We're looking to the forces that have historically supported economic market growth before we entered this recent period of accommodative monetary policy. We expect to return to an environment in which investors may be rewarded for their ability to focus on business fundamentals as markets respond to the shift from monetary to fiscal support and greater incentives for entrepreneurial risk-taking. So we see here the lead roles in supporting economic and market growth, the first one being fiscal coordination, with the next step for the U.S. economy involving some combination of infrastructure spending, tax reform, and regulatory relief. Now, we've already seen the new tax law changes, and we've probably read about the removals of a number of regulatory items. And I was just reading in the Wall Street Journal today that there is a new proposal coming from the administration about a multi-year infrastructure spending plan, and not only a plan, but also a plan to determine how to fund those needs in the future. Secondly is business investment, and to remain successful at this point of the cycle, businesses will need to invest in property, plants, and equipment. We've already read about that happening with a number of companies in a number of regions. Earnings growth, including better global growth, a pickup in business spending, and low corporate taxes contributing to better earnings. Active management, a return to fundamental investing where investors can determine winners and losers based on earnings, sales, cash flow, etc. Now, this is contrary to what a number of people believe in, which is passive or management or indexing, where we don't look to find, if you will, the winners or the diamonds in the rough, but rather just purchase proportional shares of certain market segments. And that type of low-cost passive investing can often work during sustained periods of increase in the markets. But as we get to more volatile times, as we've seen in the last few weeks, active management can play a more profound role there. And we still see bonds as an important component of a diversified portfolio to mitigate risk should we see a marked pullback in the stock market. So the economic cycle still matters, and we put ourselves tiptoeing into the second half, although with a potentially low likelihood of recession. But what may be more important in the next year is a fundamental shift that's taken place in what's driving that cycle. So on the left-hand side, we've seen some of the, quote, unusual cycle drivers like monetary policy, including low or near zero interest rates, quantitative easing, the use of debt by companies for buybacks and dividends, kind of a muddle-through approach, a take on financial market risk, and stocks being very highly correlated regardless of their size and sector. With a new back-to-business model or phase, we're looking for fiscal policy, including structural reforms, deregulation, and infrastructure investment, companies using debt for capital spending purposes, a greater confidence in the economy and markets, and a willingness to take on entrepreneurial risk instead of financial market risk, and differentiated performance amongst different stocks as opposed to high correlation and essentially doing the same thing. So if we look at economic cycles, we typically segregate them into four distinct stages of recession, recovery, maturity, and then aging. And we see below that these tables of things that occur in each one of these phases. So we're starting to see, if you will, a tiptoe from the recovery into the mature cycle, or the mature phase of the cycle. And we see we actually have kind of multiple things going on at the same time, where we're seeing recovery and maturity simultaneously. So if we look at the lingering aspects of recovery, that includes the recoup of lost jobs, a rebound of the market, a change in the approach of the Fed stimulus. But in the current state, moving forward, we're starting to see an expansion of credit, a moderate GDP growth, a slow return of inflation, a slow rise of interest rates, and yet at the same time a double-digit performance in stock returns. So forecasting ahead, we're looking for GDP growth to pick up momentum thanks to fiscal support, with an additional boost from business spending and a strong labor market contributing to consumer spending. So we're looking at a 2.5% GDP growth this year. Looking for a stock return of 8 to 10%. With continued strong earnings, global growth, and the new lower corporate tax rate. I think we could very possibly do even better than 8 to 10 if all these things play out. Bonds are still considered to be flat to low single-digit returns. So if that's the case, where are some of our recommendations for investing? Well, the first category is entitled here the heroes, and these are investment ideas we think may carry portfolios in and throughout 2018, and these are small capitalized companies. Value investments, this includes financial stocks that will do much better with reduced regulation and increased relative valuations. Cyclical stocks based upon an accelerating growth in the economy and consumer spending. Emerging markets with strong growth and attractive valuations. And yet investment-grade bonds, which are starting to provide an added yield versus what is available just from treasuries. So the sidekicks, they may not get the glory, but you don't want to be without them, include U.S. stocks because of accelerating growth, fiscal stimulus, growth with businesses spending supporting the tech sector, which is predominantly in the growth sector. Mortgage-backed securities, which we see listed here as kind of slowing Fed purchases, and high-yield corporate and bank loans with really very attractive yields, despite the fact that many of their valuations have been achieved or they've reached full valuation. The expendables, these are investments that we don't see offering much assistance in 2018. These include developed foreign bonds due to very low yields, creating a little margin for error. Developed international stocks with European growth peaking and yet at the same time structural concerns remaining. Long-term high-quality bonds, really inadequate compensation for the added rate sensitivity as a result of buying bonds that won't mature for maybe 15, 20, or 30 years. And finally, U.S. defensive stocks, which are less attractive now when we see greater growth opportunities. A number of investors, including retirees, placed a lot of their money into defensive stocks that were typically utilities that paid a relatively high dividend and typically lacked the volatility of smaller or other sector stocks. But now with interest rates rising, investors will pull out of what they view as the more volatile or risky stocks, defensive or otherwise, into fixed income. So mission possible, back to business. I love these photos. We're looking for a directional shift from accommodative global central bank policy, together with companies' increased needs to focus on growth, and this is creating a new dynamic for business leaders and investors. A fiscal response was really absent in this economic expansion since the global financial crisis, as monetary policy almost single-handedly tried to save the global economy. So we're looking for a coordinated fiscal response in terms of government spending and tax cuts to provide added support for business. Better business fundamentals, including revenue, earnings, and future growth prospects. In the wake of the financial crisis, regulation increased to control systematic economic risk, but it's difficult to balance the burden of regulation against the benefit of risk mitigation, and some felt that the pendulum swung a little bit too far, that some of the regulation was actually holding down business expansion. So some of the key action items needed for our back to business phase is an increased scope for market forces as the Fed policy normalizes, a provision of some fiscal stimulus and an increased investment through tax reform, which we've already seen, a better regulatory balance between risk mitigation and the cost of compliance. I know I've read a number of articles that said that the cost of compliance for many of the implemented regulatory directives, essentially the cost was more than any risk or damage that could have been done. So it was, again, holding a number of companies back. We've seen the administration encourage free but fair trade. I've also read articles, particularly in the old Rust Belt states, Michigan, Indiana, Ohio, Pennsylvania, where we're seeing a huge investment in workforce productivity. I saw one program where high school students would be accepted into an internship program where they would alternate 20 hours a week between school and work, learning manufacturing processes, and would be guaranteed a job paying at least, I think it was $40,000 on day one once they complete this program. The use of investment and innovation by companies to fight for market share, and our ability to manage later cycle headwinds with the appeal for rising taxes, rising rates with rising interest rates, with the valuations of companies and their associated stock rising, and margin pressure on profitability and their own pricing. So how to invest? We're looking for lower stock correlations to derive better opportunities for active management. Business investments supporting technology and industrials. Fiscal policies of tax reform providing an earnings boost to perhaps continue the bull market and to help small companies that have historically paid higher tax rates. Deregulation benefiting the financial sector, and a measured and predictive rising rate environment. We expect most commodities to see a modest price gains as the impact of stronger global growth and supply constraints offset a potentially stronger US dollar. And the strength of the copper-gold ratio may be a signal of continued economic expansion. So as potentially stronger US dollar and rising interest rates may serve to hurt somewhat precious metals and gold in particular, we see the industrial expansion and infrastructure spending potentially assisting or benefiting the copper prices or other raw material prices. So potentially stronger US dollar and rising interest rates are likely to hurt precious metals and the commodity of gold in particular more than their industrial counterparts. So the comeback. Expect better economic growth worldwide. The global economy may expand at a healthy rate in 2018 thanks to a reboot in the policy, economic, and investment decisions across developed and emerging markets to the tune of 3.7%. The international economies are continuing to show resilience, including Japan and emerging market economies. We mentioned earlier that we expect US GDP growth of around 2.5%. And business spending will be a key focus as we expect this component of GDP to have the fastest growth trajectory this year in 2018. These tables show us where we've come from as far as 2016 GDP growth in the US of 1.5% to an estimated this year of at least 2.5%, if not more. We still see very strong growth of 4.4%, trending to 4.8% in emerging markets, and global growth doing quite well as well. But we do see developed countries not doing much in the way of GDP growth, only maybe 1.8%. At the same time, at the bottom we see that inflation is still held in check at 2%, and unemployment continuing to drop to 4.2%. We also see better growth and improved business spending in 2018, and what this chart shows is what are the factors contributing to real GDP growth by economic sector, including we're seeing a stable contribution by consumer spending. We're seeing an expected reduction in government spending, but an increase, and measurably so, in business spending. Inventories are holding relatively stable. Housing is starting to slow a bit. So again, the economies around the globe are at different stages of the economic cycle with varying investment implications. So we see the U.S. stepping its toe into the mature economic cycle with the return of business fundamentals and fiscal stimulus creating opportunities. We'll get a 1 to 2 year boost from the return of this cycle, but we need to watch, as we've seen recently, rising volatility. The internationally developed markets already, likewise moving into the mature stage, have structural problems that continue to persist, but there is some improvement and accelerating growth, but the business environment is probably not even going to be as good as it was in 2017. On a brighter note, our emerging markets are still in their recovery phase, particularly the commodity producers, and any disruptions of recent years have helped the stage for reform measures, and therefore the implication is even perhaps more volatility in this sector, but the overall performance should reward patient investors. For those of you that have not heard of alternative investment strategies, alternatives are typically things that are determined to, or investments that will perform independently without necessarily correlating to the market or the, quote, stock market. So these have been things like hedge funds, managed futures, global real estate, some commodities, and we see and global macro. And we see a reference here to long-short equity, meaning the buying of equities and the selling short of equities and equity options at the same time, along with event-driven investing, which will capitalize on events like mergers, acquisitions, and spin-offs. So a number of investment managers have introduced alternative investments as a future diversifier or buffer against a downturn in equities. And with fixed income rates being so low, a number of money managers have actually replaced a component of fixed income or bonds with alternative investments. Expect flat to low returns in bonds. They are no hero. And we see here that we expect the fixed income market to be under pressure given gradually higher interest rates. So therefore, we're just expecting low to single-digit returns in bonds. There's still an important portfolio diversifier if we have market pullbacks. And we expect the 10-year Treasury yield to end 2018 in the 2.75 to 3.25 range. Now, while that may seem low, those are still very high from a global perspective, as we see Japan, Germany, and France, and the UK, a number of these, developed countries trying to continue to boost their economy through low interest rates. Our credit markets are still showing confidence and little stress. If we look at this chart, this kind of shows the relationship between investment grade corporate bonds and high yield bonds. So we don't see a lot of stress at the moment because these two numbers are not too highly divergent at the moment. We've read and heard that the Federal Reserve is reducing its balance sheet, and as early as October 2017, they decreased reinvestment of principal payments from their maturing bonds, and they're allowing $10 billion of maturing bond mortgage-backed securities and treasuries to essentially roll off their balance sheet each month. And this is going to increase by $10 billion every 3 months until reaching a maximum of $50 billion. So in the bond markets, we have a preference for intermediate term high-quality bonds, those that may mature in a 5 to 15-year range. Investment-grade corporate bonds, bank loans, they can still be used as a diversifier in a fixed income environment. Bank loans are essentially an alternative borrowing methodology for certain companies that can't use traditional methods. High yield bonds still displaying solid fundamentals, though their valuations have started to get a bit expensive. High yield bonds are essentially companies that have to pay that have less than perfect credit quality and therefore have to pay a slightly higher rate of interest. We're giving thumbs down to the developed foreign bonds, as rising levels of growth and inflation and declining central bank accommodation may make it for a tough road ahead for developed foreign bonds. In long-term high-quality bonds, we don't believe investors are being adequately compensated for the additional interest rate risk that are characteristic of these types of bonds. We expect a modest upward pressure on the U.S. dollar as the Fed hikes interest rates and continues to taper bond purchases, pushing market interest rates higher. And this will be against a backdrop of gradual and delayed tapering by the European Central Bank and continued aggressive monetary policy stimulus by the Bank of Japan. Is it a bird? Is it a plane? Is it double-digit stock returns? Saving the day. We may see, as I alluded to earlier, double-digit stock returns, but that will be a huge function of earnings growth. We also expect the stock market's price-to-earnings multiple at 19.5 times trailing earnings to hold steady in 2018 as the economic cycle ages, inflation picks up modestly, and central bank policy tightens further. So our 8 to 10% S&P 500 earnings growth and a target PE of 19 to 19.5 for 2018, and again a total return forecast of hopefully 10% or even better. If we take into account dividends as well. So we've seen tax reform, we've seen a lower corporate tax rate. We're hoping these will inject a 5 to 6% boost in earnings, putting numbers above the consensus of $146 per share in play today. So a favorable macroeconomic backdrop supports mid to high single-digit earnings gains in the next year, consistent with long-term trends. Our forecast does not include any much of the direct impact from the tax bill passage, as at the moment some of its implementation is still a bit unclear. So I guess we're kind of hedging a bit in saying that while generically these movements should contribute to positive earnings growth, sometimes the devil's in the details. There will be more favorable factors for small caps, small companies rather than large, with them benefiting more from the lower corporate tax rate, and larger companies actually benefiting more from the repatriation program. So again, to reiterate our expectations of equity market leadership, this is based on stronger forecasted global growth, continued strong earnings gains, and a tighter monetary policy with a gradual rise in interest rates, including U.S. stocks with a slight pickup in economic growth, with cyclical stocks from an improving economic environment and a strong injection by consumer spending. Small companies benefiting from a lower corporate tax rate, rising interest rates to help benefit the financial sector, emerging markets with strong economic growth and attractive valuations. Again, thumbs down on defensive stocks, a bit of thumbs down on growth-oriented stocks as opposed to value-oriented stocks, and internationally developed countries and their stock. You'll start to read about active management returning. When we've had this long bull market, there was a huge trend away from active management because I guess the philosophy was everything's going up. Why should I pay a manager money to just invest in the stock market when I can do it myself or do it via index funds or low-cost exchange-traded funds? But when we see a reintroduction of volatility, as we've seen, since the first of the year, and a more classic business cycle, well, not only investors but also investment managers can determine winners and losers based on fundamental analysis. So we're seeing a resurgence of active management just in the first quarter here. Less correlation, more dispersion. We've seen greater dispersion across individual securities, sectors, and asset classes. Rising interest rates and inflation are leading to variability in the cost of capital and profit margins across companies and industries, which should lead to better capital investment decisions. Although volatility until recently has remained low, it's expected to increase further and should keep active strategies and help them by creating more opportunities. A broader range of investments do well in stronger market breadth. Thus, the odds of active management success increase as long as correlations remain low. And as the market likely becomes more discerning about company fundamentals and valuations, these factors are favored by most active managers. The end. But the real story is just beginning. And I think what that means is that we've seen a number of bills introduced and laws passed and regulations terminated, but we've got a lot going on at the same time. So, I guess the proof will be as the rest of the year plays out. So with that, I'll say thank you very much for joining me. Briant Sikorski with Stratos Wealth Partners. If you have any questions, you're welcome to give me a call. My direct line is 919-650-1527. You can also learn more about me on my website, www.briantsikorski, BriantSikorski.com. And at that website, you can click on my YouTube channel, and you will be able to access a recording of this presentation for you to watch at your convenience. So I hope you learned a couple new facts. I hope you enjoyed the presentation, and I look forward to speaking to you again real soon. Thanks.